Today we're talking about inflation. How worried should we be about the coming inflation? I'm joined by Maggie Pagano, executive editor of Reaction. I am Iain Martin, editor of Reaction. So Maggie, we started our preamble before this discussing Andy Haldane's speech, and that's really what sparked the conversation. Inflation is very much in vogue at the moment, rising in a way that the authorities hope is transitory or temporary. Tell us a bit more about Andy Haldane's, what effectively is his farewell to the bank.
It was his sort of swan song, and you could tell from his usually colour, he's always colourful, but this was particularly colourful language, that he's rather demob happy. But as you know, Iain, he has been warning about inflation risks for the last few months. And at the last MPC, he also wanted them not to go ahead with that last bit of QE. He hasn't actually voted for higher interest rates yet, but the bank's own forecast is for 3% inflation at the end of the year. And today he dropped another, not clanger, but he was warning that it could reach as much as 4%. Now, the big question is, as you say, is it transitory? Is it because of lots of shocks to the system, shortage of supplies, higher costs for wood, concrete, partly pandemic, partly Brexit, partly, much higher demand for certain things. And that we don't know. But what he is saying is that authorities need to be ready, and his words were, to put the economic handbrake on the economy so that it doesn't let rip. That's the danger once it sets in. And of course, higher labour costs. I didn't mention that.
Yeah. I mean, is the concern, Maggie, that if the authorities don't act early on this, that if you get it wrong and it turns out not to be transitory, and there are examples from history of that being the case. I think the famous example of the Fed in the 1970s, the US Federal Reserve, where the senior figures in the Fed essentially kept on saying this is transitory and revising what was in the basket of goods and services that were measured to say, look, there isn't really inflation, until they'd kind of stripped out the basket so that it was meaningless. And there clearly was, rampant inflation. And I suppose the danger is that if you do leave it too late, then the rate rises. Of course, interest rates are needed to bring down inflation. The rate rises then have to be almost exaggerated for effect. Is that the concern?
Yeah, I think that is the concern. So it's all about timing. So do you wait for it to be proven that it is transitory, or do you get ahead of the game? And of course, the last thing you want as we're coming out of recovery, it's obviously still very fragile, is to wallop the economy now with a rise in 1% or so, or even higher. And we've seen also figures out today that consumer spending, consumer debt has gone up in May for the first time for months. So all the savings that people had made during the pandemic, so people are borrowing again, get stuck with high credit ratings. So it's going to be very delicate balance, but maybe 0.25%, it's about giving a signal to the market, isn't it?
But do you think is what's confusing people that this is a very strange, well, obviously we live in a very strange period, don't we, post-pandemic economically? It's just very hard to read, because on the one hand, there are economists and Julian Jessup, who's written for Reaction, and a few others who've been very bullish, really from quite early in the pandemic process, saying that there is this extraordinary recovery underway, that it's much stronger than people realize. And Julian's been vindicated on the upside. But it's as you say, it's a recovery which is simultaneously very strong, but also abnormal, with weaknesses, and no one's quite sure how sustainable it is either. Also, the extent of the damage to the economy. I was in central London at the weekend. It's still very strange, disrupted economy. Most of the other big city centres are the same. No foreign tourists, but then a lot of Brits out spending, eating and drinking. So we don't know. I suppose the other thing in terms of inflation is, and you mentioned it earlier, to what extent, impossible to know, are these pandemic disruptions to things like supply chains, and you should explain to people what's involved in that. That's just sort of that's shipping being disrupted and stuff coming in from China not arriving and creating supply bottlenecks, presumably.
Yeah.
Wouldn't the expectation wouldn't the expectation from the bank, for example, be that sorts itself out and you get a normalization kind of later this year, and then it does dip back below 3% and panic over on inflation?
Well, that is exactly what those who perhaps we call them the doves are hoping for. And talking about the supply chain, I mean, it wasn't just pandemic. If you remember, we also had the Suez Canal incidents. You know, there are lots of those unexpected. It was always the unintended consequences. So all those factors coming together. And for example, in America during the pandemic, that extraordinary housing boom, so that the cost of lumber went up by 4 times. I mean, 4 times. And that's pushed up European wood prices. Now, is that sustainable? Once we get back to some sort of normality, people will stop moving, they'll stop extending again. And so those prices might well settle down. What we don't have, and you've seen earlier this week, there are worries about food shortages. And the food shortages because there is a short supply of lorry drivers. And one of the other reasons is that people are not traveling overseas, they're holidaying in Britain. So you need more food in Britain this summer than you would normally do. Sort of one of those things I mean, when I read that, I just thought, yeah, I hadn't thought about that, you know, and that is hitting the whole supply chain again. So yeah, it's a very fragile and unexpected situation. But going back to Andy, you know, he was one of the bulls as well. And he was predicting a V recovery going back to last September, if you remember. He's always been bullish that we will recover and that hopefully productivity will improve. But perhaps what one didn't anticipate was some of the labour shortages.
There's the danger of overheating as well, isn't there? Just that you can have a very fast recovery, but it can very rapidly just reveal these supply shortages in the economy, which then drives up prices, and you get into this sort of cycle of despair and having to hike rates, which aggressively, which no one wants. On the labor cost front, won't a lot of people watching this, Maggie, be saying, well, labor, as in low paid Britain, let's take Britain for example, but also applies to the US as well, has had a tough 10-15 years in many respects because of globalization. Some economists challenge that and say actually the costs of all sorts of things that low paid people, lower paid parts of the economy that they spend and consume has been kept low by globalization. So there's that argument, but still labor's had a pretty tough time, and wages have been stagnant. Isn't this just part of, whether it is the pandemic or it's post-Brexit as well, a bit of a shakeout, which is positive? I mean, some of these companies who've not had to invest in, who've been able to rely on very cheap labor.
Well, Iain, it was one of the great arguments for Brexit, was it not? You know, wage compression, wages were being held down by cheap labor coming in from Eastern Europe and elsewhere.
Which was denied by a lot of economists at the time, though the figures now say something quite different, because the immigration figures seem to have been skewed or wrong. But it always just struck me, and it's anecdotally, it always struck me as an obvious point. So do you see that as is that a positive then, that Labour has a bit more power?
Yeah, I think it does. And one's already hearing anecdotally that, you know, a lot of the restaurants and bars that are now looking to reopen are having to pay higher. I think there are a couple of restaurants down in Cornwall that have been giving staff a bonus of sort of £1,000, come and join us. And it might well be that if they're investing, it's sort of virtuous circle. If they're actually taking it seriously, investing in their staff, they might start training them. So it becomes just much more, it's not just a part-time flibbity-gibbet type, you know, holiday work. That people will see this as a career. So no, I think it's very positive actually. Throughout.
Yeah, I mean, we had it at the weekend where plans to go out of London were curtailed by the fact that the hotel had to cancel because it had effectively to shut its restaurant over the course of the weekend because it simply didn't have the staff, and someone was ill and various contractual things had fallen through. So you're hearing more and more of this. The danger, though, on inflation, just come back to finally to Andy Aldane's point and his, as you put it, demob happy farewell speech. And I'm sure we'll still hear a lot more we'll hear a lot from him, and very interesting it will be too after he's left the bank. But he described inflation as being something that hurts everyone, that ultimately once it gets going, no one benefits. What's this worst case scenario in terms of interest rates, what it does to the housing market, and what it does to the economy more broadly?
Well, we've had, 10 years of historically low interest rates. There must be a lot of people that have taken out, big mortgages on very low rates. They at 2-3%, 4%. And if they're hit with a couple of percent rise, then that's going to, eat into their monthly salary, which will be eaten from a higher cost of other things. So it could be hugely damaging. And Andy, as I said, is always very colourful, and he talked about the V-shaped recovery. He's now come up with a new acronym today, which is not so fun, and that is VILE, which is volatile inflation and low expansion, sorry. So
thanks for that, Andy.
Yeah,
that's really cheery message. He did also say,
be more cheerful, actually.
Well, I thought the killer quote in the speech, and it really gave me pause for thought in terms of the historical perspective, is that he said inflation expectations and monetary policy credibility feel more fragile than at any time since 92. And the reason that 92 date is significant, 29 years ago, is that that's when the full regime of inflation targeting by the bank was introduced, with that being the sort of primary function to keep inflation stable after periods where, even despite the efforts of successive chancellors trying to fight inflation, that it was fought off and then got going again. So that's quite something. That's he's saying inflation expectations, monetary policy credibility, more fragile than at any time since 92. Quite something. But anyway, we'll talk more about this, no doubt, in the weeks and months ahead. Thank you for joining us on this reaction video on YouTube. If you're not a subscriber to Reaction on YouTube, it's very straightforward. Just hit the subscribe button to get more of these videos. If you're not a subscriber to Reaction to our website, and you want to get my weekly newsletter on politics and all of the brilliant columns and journalism by Maggie and the team explaining politics, economics, and culture, go to the website. It's in the bio below, and there is a free trial for 30 days. So you can actually now sample Reaction for 30 days and then hopefully become a subscriber and join our growing community. Until next time, thank you for joining us.
Thank you.